Imagine being the undisputed king of global footwear.
Right.
You have the most iconic logo on the planet, decades of cultural dominance, and athletes practically like begging to wear your gear.
Oh, yeah. It's the dream scenario for any brand.
Exactly.
Yeah.
But behind the scenes right now, your executives are rushing for the exits.
Yeah.
Your flagship Jordan brand is just, sitting untouched on discount racks.
Yeah.
And the numbers are absolutely sounding alarm bells.
It is a totally different reality than what we're used to seeing from them.
It really is. And that is exactly where the company finds itself today.
Right.
I mean, looking at the stock, it's currently trading at $41.32.
Right.
Which is down nearly 1.9% on the session. And it is hovering dangerously close to a critical 52-week low of $40.
Yeah, that $40 mark is huge.
It is. And the major catalyst driving this massive downward momentum, it isn't just a bad quarter. It is remarkably bleak forward guidance.
Truly bleak.
Right. Management is projecting a low to mid single-digit revenue decline for the first quarter of fiscal 2027.
Wow.
Yeah, and the anchor dragging that whole ship down is this alarming 20% anticipated drop in Greater China sales.
Which is just staggering when you think about it. Welcome to Market Pulse Daily, everyone, where we break down the latest price action, the catalysts, and the market sentiment behind the stocks moving today.
We really go beyond the headlines here to figure out exactly what is going on under the hood. So if this market update helps you make sense of the chaos, make sure to subscribe, like, and comment below with the stock you want us to cover next.
Definitely. And before we get into the underlying mechanics of today's market action, just a quick note. If you want a faster way to research the company behind today's move, you can explore StockOracle through the special 14-day trial link below in the description.
Right.
StockOracle is an AI-aided stock research platform to explore fundamentals, intrinsic value estimates, AI moat analysis, bull and bear insights, stock comparisons, watch lists, and portfolio tools.
It's a great platform.
It really is. But, keep in mind, it is a research tool, not financial advice, and it does not recommend what to buy or sell.
Right. That's important.
Yeah. AI insights and valuation estimates can be incomplete or wrong, data may be delayed, and you must verify important facts and make your own decisions. Also, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, so let's unpack this guidance. Because, a 20% drop in a region like Greater China, that isn't just a blip.
No, not at all.
It completely fractures a core pillar of their entire growth thesis. For the last decade, whenever the North American market felt like saturated, Wall Street can always just point to China as this golden goose.
Right, for just endless expansion.
Exactly. But now, looking at the recent fiscal 2026 fourth quarter numbers, that core engine isn't just sputtering. It's practically stalling out.
Yeah, the total sales, they narrowly beat a very low bar, right? Coming in at $10.97 billion.
Right.
But total revenue actually shrank by 1% year over year.
Which is wild for a company of this size. And the geographic divide here is really what stands out to me. North America managed to scrape by with 3% growth.
Okay.
But Greater China fell 12%. And the region covering Europe, the Middle East, and Africa, that declined by 7%.
Yeah, it's a rough picture overseas.
So why is the international picture, specifically China, deteriorating so rapidly right now?
Well, it comes down to a potent mix of macroeconomic headwinds and, honestly, a massive shift in local consumer psychology.
All right.
The Chinese economy is currently dealing with a prolonged property crisis.
Right.
And they have a highly cautious consumer base that is just fiercely pulling back on discretionary spending.
Makes sense. If you're worried about your house, you're not buying premium sneakers.
Exactly. But it is more than just macroeconomics. For years, Western brands were viewed as the ultimate status symbol there.
Oh, yeah. Completely.
But now, domestic Chinese brands like Anta and Lining are aggressively eating into that market share. Yeah, they have vastly improved their technology, they operate at much more competitive price points, and they are successfully tapping into this rising wave of national pride.
Oh, that's a tough combination to beat.
It really is. The consumer there just no longer feels obligated to pay a premium for a foreign logo when, the domestic alternative is just as good, if not better.
Right, which brings us to the actual product sitting on the shelves.
Yeah.
Because you can't just blame the economy when your flagship merchandise isn't moving.
Absolutely not.
And the breakdown shows that their two largest businesses, sportswear and Jordan streetwear, are in serious trouble right now.
Yeah, and we should note those categories account for roughly half of their total revenue.
Half. I mean, that is huge. And the report specifically cites difficult sell-through trends and weaker future order books.
Right.
So let's translate that corporate jargon for a second. What exactly is a sell-through trend, and why should you, as an investor, care?
Yeah, so sell-through is simply the percentage of inventory that retailers actually manage to sell to a final customer compared to what they received from the manufacturer.
Okay.
So if a local shoe store buys 100 pairs of Jordans and they only sell 40, they have a weak 40% sell-through rate.
Right, leaving 60 pairs just sitting there.
Exactly. And future order books are essentially the pipeline. It is what those same retailers are willing to commit to buying for the next season.
Ah, I see.
So when sell-through is weak, the future order book dries up because the retailer's back room is already stuffed with boxes of unsold shoes.
So they are dealing with franchise fatigue.
Basically, yeah.
They pumped out so many different colorways of the Jordan 1 and classic retro styles over the last few years that they, completely diluted the brand cachet.
Right. It's supply and demand.
Yeah. When you make a sneaker artificially scarce, people line up around the block. When it's available at every mall in America, suddenly nobody wants it.
Yeah, and that is the exact mechanism of brand decay. When half your business relies on heavily discounting previously premium products just to move that stale inventory off the shelves, you have a structural problem that takes years to fix.
Definitely.
Although, it is worth noting that performance products, specifically specialized running footwear, are seeing rising sales.
Oh, okay. So it's not all bad news.
Right. So they haven't lost the athlete entirely, but they have definitely lost the casual streetwear consumer.
Which is a tiny bright spot in an otherwise dark room, I guess.
Yeah.
But I really want to push back on something that completely baffled me in this earnings report.
Okay, what's that?
The company reported a fourth quarter gross margin of 49.2%.
Oh, right.
Now, if you just read the headline, you might think, wow, they are holding their pricing power and managing profitability incredibly well despite all these headwinds.
Sure, yeah.
But that number is basically an accounting mirage, right?
It absolutely is, and this is exactly where you have to look beneath the headline numbers. That 49.2% margin was artificially inflated by a nearly $1 billion one-time tariff refund.
$1 billion.
Yeah. It was a massive legal windfall from a customs dispute.
Wow.
So from an accounting perspective, that sudden influx of cash lowers their reported cost of goods sold for that specific quarter, artificially juicing the gross margin.
That's crazy.
It is, but it is a one-time event. It has absolutely nothing to do with how many shoes they're selling or how efficiently they're making them.
Right. I mean, it's like finding a winning lottery ticket on the sidewalk and then telling your accountant you get a raise at work.
That is a perfect way to put it.
Because if you strip away that $1 billion windfall,
Yeah.
the reality is just grim.
Very.
Underlying margins actually shrank because regular ongoing tariffs are higher.
Right.
And more importantly, their operating margin, which measures the actual cost to run the day-to-day business, dropped down to an abysmal 4.9%.
Yeah, that is a steep drop.
And that was largely driven by severance costs from massive layoffs. So because these phantom profits and inflated margins have kind of destroyed trust in management's forecasting, Wall Street is jumping ship.
Yeah, they don't like surprises like that.
Not at all. Which brings us to the win now strategy.
Yeah.
Management claims they're going to do a massive channel cleanup by the end of calendar 2026.
Right.
But, channel cleanup is just polite corporate spin for we made a bunch of stuff nobody wants, and now we have to take a massive financial hit to flush it out of the system, isn't it?
That is exactly what it is. Think of their global supply chain like a massive cargo ship, right?
Okay.
You cannot turn it around quickly. Designing a shoe, manufacturing it overseas, and shipping it takes 12 to 18 months.
Wow, that long.
Yeah.
Yeah.
So they printed millions of these lifestyle sneakers, anticipating the booming demand we saw a few years ago.
Right, when everyone was buying.
Exactly. By the time those shoes arrived, consumer tastes had shifted to sleeker runners or different brands entirely. So now, those unwanted shoes are clogging up the entire retail plumbing. To clear the pipes, you have to slash wholesale prices and practically beg your retail partners to take the stock.
Right.
It is a painful, margin-crushing process.
And because that process is so painful and the visibility into the future is so poor, the market sentiment is just turning into a bloodbath.
It really is.
If you look at the analyst actions, it is overwhelmingly bearish. Out of 36 analysts covering the company, 23 rate the stock a hold or worse.
Yeah, that's heavy.
JP Morgan recently downgraded the stock to underweight, dropping their price target to $47. The consensus means price target across Wall Street sits at $50.10.
Right.
Analysts despise uncertainty, and right now, this company just cannot give them a reliable forecast.
No, they can't. But, the analyst downgrades aren't even the most concerning part of the sentiment shift, in my opinion.
Really?
Yeah. The real red flags are coming from inside the C-suite. First, you have Chief Accounting Officer Johanna Nielsen resigning right in the middle of this turnaround effort.
Wait, why does an accounting chief leaving matter so much to the stock price?
Yeah.
I mean, executives leave companies all the time, don't they?
They do, yeah. But context is everything here.
Okay.
During a multi-year channel cleanup, the accounting gets incredibly complicated and highly scrutinized.
Oh, right, because of all the write-downs.
Exactly. You are dealing with massive inventory write-downs, you're recognizing restructuring charges, and you're navigating severance payouts. The chief accounting officer is the primary navigator through that entire financial storm.
I see.
For that person to abruptly resign in the middle of a crisis introduces a massive layer of execution risk.
That makes a lot of sense.
It makes investors wonder what she sees on the balance sheet that makes her want to step away right now.
Wow. And, what she sees might actually be reflected in the insider trading flow, which is arguably the most alarming metric we've discussed today. Over the last 90 days, corporate insiders have net sold 62,878 shares.
Okay.
And there have been 0 buys.
A 0.
Not a single executive has stepped up to purchase stock. Now, just to play devil's advocate here, executives are allowed to diversify their portfolios, right?
Sure.
I mean, stock options are part of their compensation, so selling isn't technically illegal or always malicious.
It's not malicious, no, but it is highly communicative.
What do you mean?
Well, selling for diversification is normal. But 0 buys during a period where the stock is hovering near a multi-year low, that is a glaring lack of confidence.
Right.
These are the people with exclusive visibility into those future order books we talked about earlier. They see the product pipeline 12 to 18 months before the public does.
Exactly. I mean, I have to pose this to you and to anyone listening. If the stock is already down over 70% in the last 5 years, and it is sitting right above a 52-week low of $40, why aren't the insiders buying the dip?
It's the million-dollar question.
Right. If the people with the absolute most data on the company's future aren't willing to bet their own money on a turnaround at these historically depressed prices, why should a regular retail investor risk their capital?
Yeah, that question is really the central battleground of the current market debate. The market is aggressively trying to price in just how deep this hole goes.
Right.
So let's subjectively weigh the bear case against the bull case here.
Let's do it.
Starting with the risks, the most immediate threat, even after a 70% decline, is valuation risk.
Right, because a low share price doesn't automatically mean a stock is cheap.
Exactly.
The stock currently trades at a forward price to earnings, or PE, ratio of roughly 23 times.
Right.
And just to give that some context, a forward PE tells you how much investors are willing to pay today for a single dollar of the company's expected earnings next year.
Yeah.
You generally pay a premium multiple like 23 times for a business with high margins, a deep moat, and strong, predictable growth. Paying a 23 times multiple for a business projecting flat to declining revenue, shrinking market share, and heavy restructuring costs is like a massive gamble.
It really is.
You are essentially paying a premium price for a turnaround that hasn't even begun to materialize in the data.
And that turnaround timeline is constantly under threat from intense competitive pressures, too.
Oh, yeah.
We mentioned earlier that the casual streetwear market is fading, but even in the performance running sector, upstarts are doing significant damage. Competitors like On Holding are achieving over 20% sales growth right now.
Wait, how are they doing that while the heavyweight champ is struggling so badly?
It's all about mechanism and focus. Brands like On Holding aren't trying to be everything to everyone.
Okay.
They targeted the serious running community first. They utilized grassroots running clubs, introduced superior, highly recognizable foam technology, and just built this cult following. Yeah, and because they don't have massive legacy supply chain issues, they can manage their inventory tightly, maintaining high margin, direct-to-consumer sales without having to rely on the discount racks that destroy brand prestige.
I see. So You add those agile competitors to the macro headwinds. A consumer base fatigued by inflation, higher gas prices pinching discretionary income, and the looming threat of evolving international tariff policies.
Right.
And you have an incredibly hostile environment for an international turnaround.
You really do.
But, we cannot just be entirely doom and gloom here. There is a bull case. And ignoring it means ignoring one of the most successful corporate histories of the last century.
Absolutely. The foundation of the bull case rests entirely on their economic moat.
Okay.
Despite all the current operational failures, this remains the single most dominant global athletic footwear brand.
Without a doubt.
That level of brand equity, built over decades of cultural integration, it just does not evaporate in a few bad quarters. They still possess a scale of global distribution, supply chain infrastructure, and marketing capital that younger competitors simply cannot replicate.
Right. And we're also seeing early signs of lice in their innovation pipeline. Like we touched on, performance running footwear is finally catching a bid and gaining traction again.
Yeah, that's a good sign.
Furthermore, the market is a forward-looking machine that loves a good narrative.
It sure does.
And they have some massive cultural catalysts approaching. The launch of the Victor Wembanyama signature shoe line is a prime example.
Oh, definitely.
Building a product narrative around a generational international talent like that could provide a massive immediate boost to brand momentum.
Yeah.
It could inject exactly the kind of cultural relevance the company's been bleeding lately.
For sure. There's also a purely mechanical argument for the bulls. The stock is currently sitting 48.5% below its 52-week high. You have to ask how much of the bad news is already priced into this $41 level.
That's a great point. The market already knows about the 20% drop in China.
Right.
The market knows about the inventory glut.
Yeah.
If the win now strategy shows even a sliver of fundamental progress by late 2026, the downside risk from here could be heavily limited, simply because expectations are already sitting on the floor.
Exactly. It is the ultimate showdown between entrenched legacy power and agile disruption.
It really is.
Yeah.
But, the boxing analogies people use here, I always feel like they fall a little short.
How so?
It's not just a heavyweight champion taking body blows from agile, younger fighters. The champion has the size, the reach, and the sheer capital to survive the punches.
Fair point.
The real question is footwork. Do they have the agility to pivot? Can they actually restructure their supply chain fast enough to win the later rounds? Or are they just going to slowly bleed out against the ropes while smaller brands steal the judges' scorecards?
That is the big question. So for the listener trying to navigate this, what are the specific metrics they need to watch next to see which side of this debate is actually winning?
Moving forward, you need to monitor a very clear technical and fundamental battleground.
Okay.
On the technical side, that $40 support level is everything right now.
Yeah, that's massive.
It is the 52-week low, but more importantly, it is a massive psychological barrier for institutional algorithms and technical traders. A confirmed break below $40 removes the floor and opens up entirely uncharted downside territory.
And fundamentally.
Fundamentally, you can ignore the noise and focus entirely on the late September first quarter earnings report.
Right.
The entire market is holding its breath to see the actual numbers out of Greater China. If those sales decline by less than the dreaded 20% projection, it will be a massive signal to Wall Street that the bleeding has stopped and the win now strategy is actually working.
Yeah.
But if it's worse than 20%, the bottom falls out.
Absolutely. And remember, if you want to research the company behind today's market move, you can dive deeper using StockOracle through the special 14-day trial link below in the description.
Highly recommend checking it out.
Yeah, it combines fundamentals, intrinsic value estimates, AI mode analysis, bull and bear insights, comparisons, watch lists, and portfolio tools into one platform. Just keep in mind, it is a research platform, not financial advice or a recommendation to buy or sell.
Right.
Its AI insights and valuation estimates may be incomplete or wrong, and data can be delayed. Always verify important facts and make your own decisions. This is an affiliate link, and we may earn a commission at no extra cost to you.
Awesome. Make sure to subscribe for more fast market updates and comment below with the exact stock you want us to cover next.
Definitely let us know.
But as you watch this particular stock battle the $40 line, I want to leave you with one final, slightly different thought to chew on.
Okay, what is it?
We talked about franchise fatigue and relying on retro styles.
Yeah.
Well, they built a massive portion of their modern empire by selling the nostalgia of Michael Jordan and the aesthetics of the 1980s and 90s.
Right.
But what happens to those premium margins 5 or 10 years from now when the primary consumer base Generation Z and Gen Alpha feels absolutely zero nostalgia for a basketball player who retired before they were even born?
Oh, wow. That is a fascinating point.
Right. Are they buying a shoe for a legacy they didn't live through, or will they fundamentally demand something entirely new? Keep an eye on the charts, and we'll see you next time.